Hi guys! Welcome back to the July update of my dividend growth portfolio. In this portfolio, I currently have 131,000 euros split between 20 stocks and 4 ETFs. And yes, that is one stock and one ETF more than I had in June. So I made some big moves last month. I added one new company to my portfolio and I switched my ETF savings plan to something completely new. And in addition to that, I also increased a couple of my existing positions like Novo Nordisk after they crashed last week. Last month was also one of the best ones in terms of dividend payments so far. So there is a lot to talk about today. And that's not even all, because I'll also share the second half of my watch list today. So without any further ado, let's jump right in. And if you're new here, my name is Florian. Thank you for joining me today. At the start of July, my portfolio had 120,825 euros. By the end of the month, this had grown by 7% to 131,479 euros, with my ETFs being up by 8.7% and my stocks up by 6.6%. So on paper, my portfolio had a killer month. Sounds amazing, right? But before you think that I'm some kind of investing genius, there is a twist. Because if you have seen my last update, you might remember that I was pretty busy in June and didn't invest too much. So I had some catching up to do and actually invested quite a lot. I'll come to the details in a bit, but when we look at only the organic development of my portfolio over the last month without these new buys, it looks a bit different. In this case, I'm only up by a bit under 3% overall, which is still not too bad. When we compare this to the general market, the Nasdaq still had a better performance with 3.3%. But the MSCI World and the Euro Stoxx 600 did perform worse, and I could even beat the S&P 500 again that made 2.3% returns this month. I don't take this for granted, and it is not the case every month. And by the way, I do know that since my goal is to build a globally diversified portfolio, it doesn't even make too much sense to compare it to a pure US index. But as it is one of the best known indexes and one that is often used for comparison, I'm still gonna use it here. And speaking of it, even though European stocks in general did start very strong into the year, as of right now, US stocks are ahead again. But the MSCI World, that is usually not known for its huge outperformance, could still outperform both the S&P and the Nasdaq. A large part of this outperformance, at least in the US, came from big tech again, while the consumer defense, the healthcare and the basic materials sector didn't do too well. One company from my portfolio that was also hit pretty bad last month was Novo Nordisk. I just started to buy into this company a couple of months ago and I had almost reached my target position size. But last week, the stock crashed by over 20% after they lowered their growth outlook for this year in their latest earnings call. And this cut wasn't a small one either. They lowered their sales growth outlook for 2025 by 5 to 7% and the growth of their operating profit by even 6 to 8%. As reasons, they stated the lower growth for Wegovy in the US and slower than expected growth for Ozempic worldwide. They also seem to have troubles with illegally produced and sold third-party weight loss products. Now, the thing is, the company is still growing with high single to low double digits. This is still a very significant growth. And despite the lower growth and mounting competition, they are also still the market leader in this also growing weight loss market. And even if they lose some market share against their competitors, which I honestly expect long term, this does not mean that the business for them is not growing anymore. And this lower growth was also reported on the 29th of July, the same day their new CEO was also appointed. He will start his new job on the 7th of August. So they might also want to put the bad news and performance still in the terms of their old CEO so that their new one doesn't have to start as the bringer of bad news and might even raise it again later. But this is pure speculation from my part. What is no speculation and what many seem to forget right now is that they still earn the majority of their money with diabetes care products. And this will not change anytime soon. So I actually used the crash to buy a couple more shares of Novo that currently also has a dividend yield of 3.5%. But even before that, I also increased my position in Dassault Systems after their stock also crashed by over 10% after their earnings call. Here I added 50 stocks for a bit under 1,500 euros. This is still a smaller position for me and one that is also in the red. Currently I am down by 11% with this position. But their fundamentals are still strong, even though they narrowly missed their earnings estimation from analysts, and they could also confirm their targets for 2025. The next company that I bought is a new position for me, and one that I probably should have entered even sooner. It is Alphabet, and I bought 12 of their shares for around 2,000 euros on the 28th of July. I just recently made a video about them and why I think that they are building the strongest AI ecosystem in the world right now. So if you want to hear my detailed thoughts on them, I'll put a link to this video in the description below. Last but not least, even though I didn't initially plan on buying more of them, I used the crash to buy 9 more shares of Novo for 430 euros on the 29th of July. With these new buys and the strong performance of the big techs, my portfolio allocation has changed quite a bit compared to last month. While my big techs did grow their position size and Google entered as a completely new position, the relative size of some others like Novo, Ahold Delhaize or JD.com did shrink accordingly. But that is not all, because as I said in the beginning, I also changed my ETF savings plan from the S&P 500 to a completely new one. And the one that I will use as my core investment from now on will be the Vanguard ESG Global All Cap ETF. I also made a detailed video about my selection process and the reasons why I switched, which I'll also put in the description. The short version is that my individual stocks are already pretty overweight in the US, and I just wanted to have a more diversified ETF as a core ETF. Not only geography-wise, but also market cap-wise. But I am also not planning to sell my shares in the S&P, mostly because otherwise I would have to pay significant taxes on my profits before reinvesting the rest. Thank you, German government, for taxing any investments into oblivion. I'll still have to pay the taxes when I someday withdraw the money, but until then, I'd very much like to use the Steuerstundungseffekt, as we Germans call it. Where I could not prevent paying taxes is on my dividend payments though. And July already kicked off the third quarter with a bang. First, I received €1.77 on the 1st of July from Meta. On the 7th of July, I got 51 euros from Energiekontor and 68 cents from Nvidia. VG and TSMC came in on the 11th, with VG paying the biggest dividend this month with €70.47 and TSMC still paying a respectable €90.30. Danaher finally closed off the month with €8.49 on the 28th of July. So all in all, I received €151.71 in July. So this is already more than half of what I received in the complete third quarter last year. But last year I also still had Rio Tinto in my portfolio, which was one of the bigger dividend payers in the third quarter. And as I have sold them earlier this year, this payment will fall away now. So let's see where I'll end up by the end of the quarter and if the dividend payments can really surpass the ones from last year. Last month I started to show you my watch list. And I already covered the companies from the industrial, construction, finance and consumer sector in my last portfolio update. Today, I will show you the rest, which includes companies from the healthcare, the technology, semiconductor, and resource sector. But before we go there, if you like the video so far, please hit the like button and subscribe to the channel so you don't miss the next one. I know it's a bit annoying if I ask this, but it really does make a difference and helps the channel a lot. And as a small thank you, I promise you to reply to all of your comments. So thank you very much. And now, let's start with the first company on the list today, which is the pharma company Eli Lilly. They are a US-based pharmaceutical company with a strong focus on chronic diseases, particularly diabetes, obesity and autoimmune conditions. They are operating in similar markets as Novo Nordisk and have become a major player in the fast-growing obesity drug market, with its GLP-1 therapies driving a significant share of their recent growth. These two companies are also now seen as direct rivals in this space. But beyond this, Lilly also has the broader footprint in areas like oncology and neuroscience, which gives them a more diversified pipeline compared to Novo. Their performance was also nothing to write home about in the last years, but they did still perform quite a bit better than Novo did. Right now, their stock price is towards the lower end of their 2-year range, but their valuations are still pretty high and around their 5-year averages. I do like their diversified business and I think they have great growth perspectives. But this also comes at a price. And at least of right now, I am not yet willing to pay this price. So next, we already come to the technology sector. And here we also have two companies that I generally like, but of which I'm also not willing to pay the price. Both are data integration and analytics companies with a large focus on AI. Snowflake and Palantir. Snowflake is a cloud data platform that unifies data warehousing, engineering analytics, and sharing across different external clouds like AWS, Azure, or Google Cloud. So they are a highly scalable SaaS company. Unfortunately, they are not profitable yet in terms of GAAP numbers. This is an absolute mandatory requirement for my investments, so they are stuck on my watch list for the time being. Palantir, on the other hand, is focusing a bit more on custom-tailored and client-specific implementations of their platforms that are largely, but not only, targeting the military and defense sector. The stocks of both companies had a great performance this year so far, with Palantir being up by over 100%. But their valuations are also beyond good and evil and well within hype territory. So they are a pass for me. I'll still keep them both on my watch list, and if their valuation comes down to more reasonable levels, I'll be happy to add one or both of them to my portfolio. The next company on my list, and also a tech company, is actually not on this list anymore because I just bought it. It is Alphabet, and I entered my position in them last month, as I just showed you. My investment case for them is that I believe they are building the strongest AI ecosystem in the world right now with their TPU chips, their Gemini AI, and even businesses like delivery drones, autonomous driving cars, or quantum computers. And I also think that the concerns about their search business are overblown right now. I lay out all the details in my deep dive on them, so if this is something that sounds interesting to you, the link is down in the description below. But because I have just bought them, let's remove them from my watch list together. And this brings me to the next sector and the next company, which is Broadcom and the electronics technology sector. Broadcom is a provider of semiconductor solutions where they develop a variety of chips for many different applications like smartphones, networking gear, or data centers. But they also provide infrastructure software, which includes cybersecurity or enterprise software. With all their products, they focus on mission-critical tech. This mix between chip design and software provider is pretty unique and has enabled them to grow their stock price and their dividends pretty quickly in the last years. It also has a good growth potential, especially with the products for cloud and data center applications. Right now, their stocks are trading close to their all-time highs, but their valuation is also well above the sector median and also their own 5-year averages. When I started my position in Texas Instruments a couple of years ago, I debated whether Texas Instruments or Broadcom is the better investment. I decided for Texas Instruments in the end because they grow more organically than Broadcom does and they have a larger focus on investor-friendly capital allocations. But as of right now, Broadcom would have definitely been the better choice. Next on my list is a Japanese company that I added just a couple of weeks ago. It's the semiconductor equipment manufacturer Lasertec. They are specialists in applied optics technologies and offer inspection and measurement systems for semiconductor manufacturing. Similar to ASML's position in lithography machines, they are the market leader for EUV and DUV photomasks and wafer inspection systems. So while ASML makes the machines to illuminate the wafers, Lasertec is building the tools to make sure that the photomasks and in the end the wafers are correct and without any failures. Their stock price is roughly at the same level as it was by the beginning of the year, but in the meanwhile, they were also 40% above the price today, only to come back down again. But their fundamentals are pretty strong and they could also grow their dividends by an average of 34% every year for the last 5 years, which is pretty insane. Similar to ASML, I do like their market-leading position and their strong fundamentals. But they are also operating in the same cyclical semiconductor industry as ASML that is currently in a down cycle. I only have them on my watch list for the time being because they are pretty similar to ASML, which I already own. And that brings me to the second last sector, the resource sector. I have 2 companies here on my watch list, but one that has a yellow mark. This means that I currently don't have any plans to invest in this stock. I'll still keep them on my watch list to keep a close eye on it, and my investment thesis for both of them is pretty similar. I think that the infrastructure buildup, the data center investments, the trend to renewable energies and autonomous driving cars, and generally the trend to more digitalization and connectivity will push the need especially for copper, but also other construction materials such as steel in the next decades. I already invested in Rio Tinto after the downfall of Evergrande in China because I was betting on a comeback of the real estate market there. What I like most about them is their general size and their diversified portfolio in different resources. While the majority of their revenue comes from iron ore, which is of course hugely important for steel production, they have tried to diversify the business even more with the acquisition of copper and lithium mines in recent years. Unfortunately, the comeback of China's real estate market did not happen as of right now, and I also think that it will take far longer than initially expected. That is also why I sold out of Rio Tinto earlier this year again. But I actually don't think that they are a bad investment, and especially for investors who are looking for a large dividend yield, they might be worth a deeper look. Right now, they are paying a nice dividend with 6.7% yield. Freeport-McMoRan, the second company I have on this list, is much more specialized. They are one of the largest copper producers worldwide and operator of several high-class mines such as the world's largest gold mine in Indonesia and numerous large copper mines in North America. So, in addition to copper, they are also producing gold and molybdenum as byproducts. And they are not only mining these minerals. They are also operating several smelters and refineries to further process these metals. And with this business mix and their assets, they are in a prime spot to benefit from the rising need for copper especially. But same as Rio Tinto, their stock did also mostly go sideways in the last 5 years, and with their much smaller dividend of 1.5%, you also don't get paid to wait with them as you do with Rio Tinto's much larger dividend. I am still convinced that the demand for copper will grow very significantly in the next years and even decades. This gives great tailwinds for these kind of companies. But I am far less certain if the capex heavy business of these mines and resource companies, which also brings a lot of risks, is really worth an investment or not. Last but not least, I have one more company from the boring old transportation sector on my list. Except the company itself isn't boring at all. I am talking about Uber. If you don't know them yet, they are a platform provider for ride-hailing, delivery and freight services. They basically connect drivers with their riders via their app or let customers order a home delivery from their favorite restaurant or retail store. They are also operating a digital freight brokerage service that connects shippers with carriers. With these services, they are the market leader in 8 countries and are still growing pretty quickly. Since the beginning of the year, they are up by over 40%. This is pretty nice because I actually also ranked them as one of my top picks for this year back in January. I think that they still have a lot of room for further growth and that the shift to autonomous vehicles in the next few years will further enhance their value proposition and potential. Now, I do have 2 more tickers on my watchlist, but both of them are for the same ETF, which is the First Trust Nasdaq Cybersecurity ETF. This is a higher concentrated alternative to the iShares Cybersecurity ETF that I already own, and I mostly use it to compare the performance between the two. So there it is, my complete watchlist as of right now. But I am constantly adding and removing companies from this list, and I am also no financial advisor. So please, don't use it without doing your own research and your own analysis first. And that's also just how I see it. Which companies do you have on your watchlist? I'd be really interested to read about them down in the comments. And guys, as I mentioned in the video, I just switched my ETF from the S&P 500 that I have used for years now to the new Vanguard one. If you would like to know my reasons and my reasoning behind this, check out this video where I lay out all the details. That being said, thank you so much for watching guys, and see you in the next video.